Hello everyone, and welcome to today's webinar, Demica Insight Q1 2022 Benchmark Survey Results. Before we get started, I would like to go over a few items so you know how to participate in today's event. You've joined the presentation listening using your computer speaker system by default. You will have the opportunity to submit text questions to today's presenters by typing your questions into the questions pane of your control panel. You may send in your questions at any time during the presentation. We will collect these and address them during the Q&A session at the end of today's presentation. Finally, today's webinar is being recorded and you'll receive a follow-up email within 24 to 48 hours with a link to view the recording. I would now like to introduce Maurice Benisti, Demica's Chief Commercial Officer, to begin the webinar.
Thanks a lot, Dan. So just a quick run through the agenda. We're going to take you through the platform data a little more quickly than usual because we've got the highlight really of this session, which is the benchmark survey that we ran with banks in the first quarter. We're going to discuss them with our panel. So I'll move on to introduce our panel, I think. So we have with us Jeff Brady, Head of Supply Chain, Global Trade and Supply Chain Finance, Bank of America Merrill Lynch. So welcome, Jeff. Great to have you. Michael Hart, Global Head of Trade Receivables at Standard Chartered. We have Sean Edwards, who is the Chairman of ITFA and Head of Legal at Sumitomo and heavily involved in their trade business on many fronts. And we are expecting John McQuiston, so we'll hope that he joins us imminently and expect him to be there. So it's a tremendous panel. Really, I'd like to reiterate our thanks from Demica for the panel to join us. A lot of experience, real global experience, and we're going to use that to talk about what's going on in our sector, some of the insights that have come out, and particularly some of the regional differences that we see. So if we move on, market trends. So just a very quick reminder on the sample that we use. So our platform supports over 500 sellers and around 1 million plus debtors across a range of different products. So we pull that data on a monthly basis, aggregate it quarterly, anonymize it and index it. And we started doing this through the pandemic and have kind of carried on. So we'll share, as I said, briefly, some of those key outputs. So really just focusing on 3 sectors today: computer and electronics. So this is computer hardware, some software, some services, where, you know, as we've said many times, huge spike post-pandemic. What's interesting about Q1 is the delta that we have relative, I think, really to 2021. So you are starting to see a slowdown, still very elevated, but that kind of push for the end of the quarter means that Q1 sales across the board will be significantly down year on year. You're starting to see that show up in analyst forecasts and I think in companies themselves as they report. So no surprises, but certainly will be interesting to see how that progresses through the year. Transportation and logistics, really interesting because you're seeing the opposite of what you'd expect to see over the quarter, vis-a-vis, you know, kind of growing through to March, and you've got declining levels, still 50% higher than pre-pandemic, right? And our data is weighted towards Europe, and we'll be watching carefully to see how this, you know, how this moves over the balance of the year. You know, but you're again hearing from clients seeing significant declines in spot rates, and as longer-term contracts unwind, you know, whether it's economic slowdown or a recovery to the mean, that'll be one again to watch. And the final one, tier 1 automotive. If there's a sector that just can't catch a break, it's this one. So supply pressures held back a recovery of demand post-pandemic, and it's a very slow start to 2022 with problems that existed before continuing, and now, you know, being kind of seeing demand soften. Is what we hear from our customers. So a mixed bag, and I think, you know, key insight from us from a commercial perspective, talking to our friends at the banks and to some of our corporates, you know, looking to see whether the combination of some slowdown, higher interest rates and inflation, what it does for our market. And I'll save that for the survey because I think there's some good overlap to those points. So let's dig straight into it. We've got here just a summary of the survey results. So I'd like to start off really by thanking Dan and Catherine, who are with me in the room today, for the hard work they put into this report. I think we got a great output, really good feedback, and thanks to everybody who filled it in. across the regions, really. So you can see where the spread is by country and by function. And I guess what I'd start with as an observation that came out of the survey was just the different ways that different teams identify themselves and their products. And something that we talk about a lot, or we hear about a lot, is the attempt to derive some consistency of naming convention across the industry. We try to stick with the Global Supply Chain Finance Forum definitions. But I guess my question to the panel, and I start with Jeff, does it matter, right? What are the benefits of more alignment, tighter alignment of what we call our products in the industry? How does it help us? How does it help our customers?
Thanks, Maurice. So, as I've said to the group, I'll try and adjust myself in the camera so you guys can gaze out onto the majesty of the New York skyline as I talk, rather than having to look at me. It's interesting. There's two ways we think about the naming conventions in trade finance, and I say this all the time. It's one of the areas of banking where there's probably a bit of a disconnect between sort of a corporate treasury and we in the banks. I don't think that corporate treasurers would consider themselves sort of experts or even fluent in knowing the difference between supply chain finance, reverse factoring, certainly not the more nuanced trade finance products. And then we in the bank sort of parse them the way that we parse them, and mostly because we've done it that way for just a long time. And to your point around the Global Supply Chain Finance Forum, it's, I think it behooves us to be consistent for a couple of reasons. And I think, we've seen this maybe in the most drastic way been borne out when there's these issues that pop up around some elements of trade finance, right? We, the Abengoa Carillion have been sort of blowing around for a number of years, and recently with Greensill and others, and part of the issue for us in the industry is to make sure that folks are describing things correctly. So, and what you don't want is somebody to sort of come along and say, hey, this is supply chain finance, and then that's the problem, and this is causing all these issues, right? Where first thing we need to do is just sort of say, hey, look, here's how we define this, because what that is not supply chain finance, or it's not reverse factoring, or whatever we want to call it. And I think there's a bit of usefulness to that, because the first thing we don't want is for some of these relatively benign products to get tarnished because they're sort of being purported to be something that we don't believe they are. So if we're consistent in how we talk about it, and we get sort of questions from either the press or from forces in the industry, or even jurisdictionally regulators, lawyers, whatever it might be, that we're consistent so that we can say, look, this is what this is and what we call it, and then make sure that it's being portrayed correctly when some things like that arise. So I think that's part of the usefulness to it for us. And then also, I think, again, the more consistent we can be, then the more it starts to feel consistent for our clients, right? And I think that's true probably regionally as well. If we can be consistent, then our clients can kind of understand this is what we're doing, and then we're kind of all on the same page. So I do think there's a usefulness to the consistency, Maurice, from our perspective.
Yeah, thanks. And we'd agree with that. I think, if it's more consistently understood, you might accelerate the buy rate, right? Just you spend less time kind of clearing up some of these, some of these questions early on in a sales call, and the benefits become more readily identified with the products. Sean, what do you see? Kind of cross banks, obviously, from the perspective of ITFA.
Yeah, so from my perspective, I'm actually one of the authors of those definitions in the GSCFF. GSCFF, for those who don't know it, is actually composed of all the trade associations ourselves in it, for ICC, BAF, FCI, the factors, and the EBA. And it was an interesting journey. One of the to get, and I think there are two ways of looking at this. There's the industry, and I'm going to agree with Jeff here. There's the industry need or the industry benefit, and agree with you as well, Maurice, that it really does save a lot of sales time. And there it's really important, I think, for democratizing and making the product understood. And that's especially true when you go into different markets where people think about supply chain finance. they often think just of payables finance or reverse factoring or confirming. A number of those synonyms that are all set out. That's something we did for all the techniques. What is it? So part of the problem was there was this sort of Tower of Babel issue that everybody was calling it different things. So very useful to have a single term. One of the important things I do want to point out, though, is supply chain finance is much bigger than just payables. And that's one of the things that we've always tried to be very religious about, that when we talk about this in the GSCFF, when I do educational seminars and webinars and what have you, I'm doing one in Tallinn at the end of May, speaking to a relatively immature audience, although not as much as you might think. It's important to point out that actually there's a huge universe of supply chain finance, and payables finance is only one of those. Although it's probably the biggest, or one. Well, receivables and payables obviously are two bigger. But so I would say that's really important for people to understand. I'd say within the industry. I mean, I remember one of the draftsmen said, well, at the beginning of this, well, we call it whatever the client calls it. And I think banks were not, if you're dealing with somebody who really understands, you don't need to be so worried about what you call it. But then there is this, all these different sort of Tower of Babels going around, and it's not ultimately beneficial for anybody. So I think even there, I think the banks and the other trade finance providers took a long time really to come on board, longer than maybe we would have liked. Now it's beginning really to get rolling. There is also, which Jeff has mentioned, the regulators issue was always intended that this reached the regulators, and we're beginning to see a little bit of pickup of the definitions in a couple of the reports, for example, on Green Steel in the UK.
Yeah, no, I mean, one anecdote from our side is we're using the broader definition of supply chain finance, but our competitors, from a platform perspective, typically don't. So, your ability to define it that broadly, it resonates with the banks, but it becomes actually for corporates, they're being sold it as something different. So it's an interesting tension. I guess. Moving on perhaps to the next page, where we've got some really, some really optimistic and encouraging forecasts that we're seeing in terms of market growth, right? So I'm interested, and we've got here how much is asset growth expected to change, how much is headcount expected to change. And so I guess I'm interested in, and perhaps we'll start again with, let's just start with Michael. What type of resource do you think, well, first of all, do you see the same growth drivers, right? When you look at your business, do you see share the outlook that came from the survey? And then secondly, what type of resource do you think that you might need, and how does that change?
Yeah, sure. And to answer the first question, yeah, very consistent with your data in terms of what we're seeing in the market as well. Particularly if I look at our Asian market, we're increasingly seeing particularly tech companies moving from Eastern focused into Western growth as well. If I look at so mobile phones, and using your data point there earlier from computers and electronics, we're also seeing the likes of Oppo and Xiaomi moving into the West as well. And from China, we're seeing a lot of innovation, not from necessarily a tech perspective, but from a structuring perspective of certain facilities and how they look at receivables. So we're definitely seeing that come through. And in terms of sort of the roles that will go and are increasingly coming with that growth, obviously you're seeing product managers there, but you're also seeing obviously the legal teams grow as well. So there's a lot of resourcing in that area because obviously there's that need now to look broader from what has been a home market into a Western market. We've obviously buyers on this side of the pond, and again, sales folks, risk, compliance, to understand the local nuances that come with now dealing with a Western industry. and a Western buyer base. I think
And I'm interested,
interestingly,
if I could break in, I'm interested, if you look at the commercial, like the sales and the risk resources, does that tend to come from other product functions? Are you growing it yourself in terms of talent? You know, how do you, how does that manifest? And are there things that the industry could be doing better to, to create that funnel of talent into our product set?
yeah, I mean, I think receivables, if I look at receivables, which is where I sit, albeit have been in payables as well in my previous career, it's still a very sort of nuanced industry. It's a product within a product. You look at open account compared to stock trade, but even trade in itself, I remember one of my very first line managers at a previous organization, 30 years in the industry, and I remember her telling me quite often, despite how many degrees are floating around on the floor, there's an element of what you can't be taught in a classroom in trade finance, and I think that's very, very true. So there is an increasing need for that experience and that knowledge. To your point, what can be done? I am, a big supporter of more education, and we obviously see forums, and panels like this sharing that knowledge. Some of it you only learn, in real terms by doing, particularly if you're looking at the risks elements. Some of it, you really need to be at the coalface and talking with clients, and and dare I say it, a few bad experiences when things go wrong. But yeah, I mean, definitely increasing panels, forums, sharing information, experiences. That all definitely helps for, like you say, the new crop coming through. I mean, I didn't start my career in trade finance. It was actually in a very different area of banking. But again, it was learning, really on the job type of thing.
Great, Jeff. What about North America? I mean, again, I think you validated when we chatted before the optimism on the growth. Be interested in your perspectives on the the resourcing side, and also given the relative, I'd say, and please disagree if you feel, but the relative immaturity of the some of the products in North America relative to Europe, how that plays out over time.
Yeah, so it can work for you or it can work against you. So I think if we think about the asset side, I think you see the sun come up every day, you start to believe it, right? And as we've sort of been through the financial crisis, we've been through COVID, and we look at the continued asset growth. I mean, you sort of, if you look at the aggregate of trade finance, you sort of say you may see some dips and curves, but I think if you think about, particularly on the payable side, you see that that's still double-digit CAGR, close to it. So I do think that kind of offsets where you have some of the dips. So I do think your survey, I would sort of agree with the what you see in the survey, which is there's a lot of bullishness around people feeling like that the assets are still going to continue to grow, because I do think there's an element of untapped greenfield for payables, receivables, working capital optimization. I think there's been this slow journey, I think, for corporates globally to recognize that there's never a right or a wrong time to do it. It always is the smart thing to do. So I think just making that a part of their business is probably something that's they're all coming around on. So I think that's facilitating some of the growth. So in terms of the folks that we have supporting it, exactly to your point, Maurice, I think as we think about where our talent comes from, I think it's probably a little different than it was 10, 15 years ago. 10, 15 years ago in the US, I would think, and maybe to some extent globally, there was a bit of probably consternation about how you would recruit trade talent. To Michael's very valid point, a lot of it is going to be experienced. So how do you sort of sign up folks, at a junior level to sort of sign up to get that experience? And then what's the sort of, the end game? What's the light at the end of the tunnel? I think what's changed in the last 10 or 15 years, and maybe even closer to 5 years, is that, you actually see this sort of wholesale shift in transaction banking, Whereas it used to be a very mechanical type of business. You know, I remember a few times hearing it described as the plumbing, right? And thinking to myself, boy, that's the last place I'd want to go for my career, to work on the plumbing of the banks or anything else for that matter. And frankly, I'm not sure I'd be qualified to do so. But point is, so if you think about what it is today, though, you know, you think about all the activity in the fintechs, and you think about all the activity with blockchain and DLT, and the different ways to do payments, and the fact that, you know, it's very real for people, particularly juniors. It's very real for them, right? You know, using mobile apps to make payments and to, you know, do their banking or whatever it is. And then when you sort of juxtapose that with the kinds of things we do, payables and receivables, you know, that can also be facilitated in a very sort of mobile digital way. And all of a sudden, what we do starts to be a little bit different, and there's a little bit of a different conversation, and we start to recruit from different places. So, you know, it's interesting, the people that we see today coming in from fintechs, from software companies. I don't know that we would have said in trade finance that's who you'd see 15 years ago, but today that's kind of a little bit of what we see. So, you know, I think then the onus is on us to be able to take some of that and that talent pool and be able to organize some of the experience that Michael talked about that is going to be necessary for them to facilitate, you know, trade finance as we go forward. Because I do think it's going to be sort of a little bit digital, a little bit finance, and it's sort of a unique place for those two things to mix. And I think that's what makes it kind of interesting. So I do think there's that. And, you know, in terms of what they're going to be doing, I think what we hope they'll be doing less of, but I think the reality is that particularly now they are still doing a bit of, and that's the mechanical side of what it is we do in this business, facilitating these payments, the diligence requirements that we have in order to connect kind of buyers and suppliers, and, you know, whether it's onboarding or whether it's, you know, being able to sort of, you know, accept or pay, you know, people, entities, whomever, while staying within bounds on all the regulatory and judicial oversight that we have. And, you know, that's a part of what we do today. And I think, you know, the reality is, as we grow our businesses and you see that asset growth that we've referred to, you know, that mechanical side still sort of tends to increase in terms of talent, headcount, et cetera. Hopefully over time, we can decrease that with more efficiency, and then we can use the talent to really sort of be able to provide more solutioning, origination, and that side of it going forward. But I do think we're probably in a different place than we were 5 years ago, and I think in a good way, frankly.
Yeah, no, that resonates with me. I mean, it always reminds me of the payment space, which was part of the plumbing, and payments has become such a super attractive area, you know, with some huge companies that are coming out of nothing. We hope that that happens to trade, because just a small increase in market penetration makes a massive difference to the, you know, the kind of asset base and the broader kind of commercial opportunity of the product. Sean, anything you'd want to kind of add or subtract to that?
Well, I'd add, I think, points by Jeff and Michael. I think, you know, that there is big asset growth here in terms of the gross numbers, if you like. That's partly because the corporates are seeing, and smaller corporates seeing the benefit of working capital optimization, and that's being rolled out. It's being understood. It's being applied at all sorts of different levels. I mentioned earlier on, I'm off to Tallinn at the end of the month to talk there, not just to Estonia, but to, you know, regional businesses, including, we hope, some Ukrainians. But that's something that's being rolled out there, and so I think there's asset growth coming from that. I don't think that proportionately that leads to, and maybe it's a good thing actually, it leads to proportionately the same increase in headcount. And part of the reason for that is that there is a lot more tech going into this. You know, the passage of it's been mentioned, the sort of passage between banks and fintechs of people coming in, and the knowledge that's being accumulated in both means that actually we can do these things much more efficiently. I think there's also maybe some structural elements, I don't want to call them problems, but some structural characteristics of the market, which is that it's obviously dominated by, especially I think in the US, by very large buyers, the Walmart types. I know it's being rolled out to smaller buyers. In the rest of the world, that's happening much more. That's happening much more slowly, actually. But the ball is rolling there. So asset growth, I see that definitely happening. Let's say not so many people to service it, which may be a good thing. But some really interesting points made by Michael about, about where the talent is coming from. And I actually, being a lawyer, I sort of had to go to university, but I sort of rue the fact that too many people have degrees actually go into banking, and certainly in my association, where we started 20 plus years ago in the forfeiting market, these are people who had learned these now, because they're people who learned on the job. They are immensely experienced people. They really understood the business. They started in many cases from doc collections, examining documents. So they really got an intimate understanding of how the business worked. In fact, my wife started like that in the business. So and it really was the route to really understanding trade. People don't want to do that. Graduates don't want to do that. And after the GFC, after the global financial crisis, there was a lack of investment in trade because it was the easiest to run off. That's a whole other thing we can talk about. But there was a lack of investment. So the training that sort of Michael is talking about, a lot of that is on the job. The associations, including my own, do a lot of education. We've been doing for the last 3 years a series of lectures, for example, at the Bayes Business School in London for postgrad students who are actually interested in trade, or think they might be interested in trade. And then when you talk about it, they said, really, this is an interesting business to get into. I like it. It's real. To Michael's point, it's real. I'm doing something good, and increasingly that's what a lot of the newer entrants to business want to see. They want to do something that's worthwhile, helps the planet. I believe trade does that.
We see that, and we see a lot of talent now passing from service desk implementation into sales, right? Because ours is a technology sale at the end of the day. But when we're first hiring people, we're hiring product people from banks. So as the scale of the business increases and as that transformation happens, you'd expect, I guess, to see that happen first in a fintech. But that's certainly something that's changing. Let's move on to some of the challenges that we saw. So don't propose we go through the list. This is really just a reminder of some of the findings. And I guess it will be helpful, what I wanted to get to here is the extent to, what is holding back growth, right? Because on the one hand, that's a strange question given what we've just discussed. The survey says everyone expects more growth. On the other hand, you have this famous 1.5 trillion trade gap, right? That suggests, and everybody feels that this market should be growing faster, could grow faster. So we picked out some questions to ask people, which really are at the micro level. But I guess I'd be interested region by region, perhaps starting with Michael with a perspective on Asia. What would make the difference? Is it things on this list, or is it more, is it more holistic than that would drive growth even further?
Might be a little unpopular point in this one. I think some of those challenges there that we've had as an industry for quite some time, then they're not not insurmountable. They're not unachievable. And looking at that list, we deal with them, especially when we're entering new markets, and we manage them, and we find solutions for them. The 1.5 trillion gap is a subject I've spoken about quite a bit in other forums as well, and I don't think just looking at that particular point, I don't think those challenges there necessarily stop the reduction of that gap, which does need to be reduced. There is a place there for regulatory change, particularly if we're looking at the emerging markets, the ability to do due diligence, share information across banks. Now, obviously, that's a massive topic in itself, because then you start talking about the data exchange and data protection and how you move that information from one bank to another. You start looking at markets where typical traditional sources of identification don't necessarily exist. So, I can say my own organisation, in particularly the emerging markets, have found solutions to do that through mobile apps, for example, which capture certain information, and that innovation, I think, will play its part. It will still come down to sort of changes in regulation. Yeah, again, that's not to forget and try and dilute any of the due diligence requirements that we have to do and we want to do to make sure we're lending to the right individuals, the right businesses. We've seen what's happened in the past when that goes wrong. So I don't think those challenges necessarily on the screen are the ones that will prevent us from closing that gap.
It's a great point, and I think what one for the next survey perhaps for us to think a little bit more strategically, because some of these are very operational, these are tactical, and they're driven also from our insight, which is what can we build in order to help, right? But I think your point is very well made, that isn't necessarily what solves something that's more that would drive more a strategic shift. And I was thinking as you were speaking about, I think your investment in LinkLogis and some of the tools that were deployed in order to completely change the way KYC was done in certain jurisdictions. Jeff, same question to you with respect to North America.
I very much agree with what Michael had described, and I think we are all cognizant of the trade finance gap, and I think the way that I think we would probably look at it, if I look at your list and I think, what's preventing us from doing more, and I get this question a lot just here at Bank of America, because, they tend to like the short-term quality corporate assets, right? So the question often comes like, how can we do more? Why can't we do more? What's stopping us? And my answer is generally, similar to Michael, it's really around the mechanical side of it. We talked a little bit about it a minute ago. It's about, how can we get comfortable with counterparties? To what level do we have to do that due diligence? Is it a full KYC? Is it some subset of a KYC? What kind of resources are required for us to do the sort of diligence that is required for us to do? In many ways, right up until recently, and maybe even recently, you've got, wet signatures required in certain places. You've got very direct correspondence that needs to be done between counterparties A and B. And, these are all mechanical things and they're all resource constraints. So, from our perspective, clearly you're not going to be able to do another $1.5 trillion of this stuff if you've got to do a lot of that. And then we'd all be honest or sort of disingenuous if we didn't say that, a lot of that $1.5 trillion is going to be on the smaller supplier side. Now, you've sort of noted this as you look at your list, maximizing financing by accessing smaller sellers, the SMEs. And I think that's where a lot of this lies is, how can we connect that group to the capital that wants to invest in trade finance? And then here's the good news. And we say this all the time. There is a lot of capital out in the market that wants to invest in trade finance. I talk to asset managers all the time. I'm sure my counterparts do as well. And they're all looking to invest in, quote, trade finance. And what they mean, really, when they say that is they want to invest in diverse portfolios of receivables. That's what they mean. So you've got all of this capital that wants to invest in it. And then you've got this $1.5 trillion trade gap. The question then becomes, so how do you connect that capital to that trade that is the gap? And I think right now, the disconnect is the mechanical side. It's the diligence requirements. It's the resources that are required to be able to do it, given those diligence requirements. So how do we solve that? To Michael's point, and Sean alluded to this as well, some of this is going to be standardization, the boring stuff. How are we going to standardize, what's jurisdictionally required in different places, KYCs, is there utilities that we're going to be able to access to be able to do some of this? And as some of that gets solved, banks are going to be able to create more and more of a sort of an asset pool of these receivables. And then when that happens, you've got the banks then can be clever about being able to, whether it's securitize those or create some sort of a conduit where exactly what's in there, right? And I say that in regards to some of the high profile sort of explosions that have happened in the industry where it hasn't gone well. But if you can create vehicles where we know exactly what it is, it's trade finance, and then you can get those out into the markets, then you start to close that trade finance gap. But in order to do that, I think it all starts with the mechanical side of what banks are required to do, because the bank credit will dry up at some point, but that's fine, because then you've got all of the investors out in the community that would love to get a piece of this stuff. If you were going to say, hey, we've got an opportunity for you to invest in something that looks a lot like commercial paper, but frankly, we think is a lot less risky even than commercial paper because it's a commercial relationship underneath it. I think they would all love to do that. They'd sort of look for things like, is it rated? Is it publicly traded? And those are all things that we can get to if we can solve the first part. So that's my view of why we're not doing more of it, how we might be able to do more of it. It's not simple, but I do think we spend a lot of time and energy on it as an industry, people like Sean and industries like the ICC and BAFT, et cetera. But I do think that's the work that needs to be done.
I agree with that. I think some great points. I think we're seeing a lot more demand for tools and applications that enable risk distribution, that enable banks to have their portfolio information, accessible at the transactional level, at the debtor level, so that they can be more creative around structuring. And as that diversification grows, they can use risk distribution in a way to drive more, they drive some of that capacity into the non-bank market. And as that happens and origination models become more efficient, that goes to a lot of what's been describing. So it certainly resonates in terms of our customer conversations. Sean, what would your add be, particularly thinking about the European market?
Yeah, so I mean, look, I think a lot of the focus, and Jeff just mentions what is the operational side, the cost of KYC and so on. I mean, it's long been touted as one of the reasons why you can't and it's interesting on both the payables and the receivables side. The issue is around probably the smaller suppliers, the smaller counterparties. I actually do think that that's been a little bit of a pretext for not doing business with unprofitable clients or risky clients in many cases. And so I really endorse the point that Jeff has made and that you've just mentioned, Morris, because it's people like you at Demica who actually have the tools to solve this. But actually bringing in diversified pools, as Jeff has said, that are attractive, maybe have insurance, and I know that hasn't worked out very well recently with one very high-profile name, but it can be made to work, and it has worked in most cases. Of course, you only hear about the ones that go wrong. But those, and we're doing a lot of work in ITFA, for example, to try and bring those sorts of investors in because they are interested for the reasons Jeff mentioned in trade, and it's a good pickup, it's relatively safe, and so on. Maybe it's a little bit complicated at the moment for a lot of people to get their hands around, but it's a great asset class, I think, for a large bunch of investors. Now, once you've got that sort of demand side, the supply, I've always said, I think the supply will follow. At the moment, banks are, I think they do use the excuse of it's too expensive to KYC because it's whatever the cost is, it's $10,000 per supplier, and I just can't make that from these small guys. But if you can package them up, if you can bring in the right credit appetite for that, then I think you can reach it. And that is something that is happening very, very slowly. But I think we really do have the opportunity now to make a really good stab at that, and it's starting to happen.
And we've had a question from the audience, which is what best-in-class banks or fintechs have done? What have they done to close the gap in terms of onboarding and education of suppliers? So obviously can't impartially answer the question on fintechs. An observation on some banks and on some fintechs was to eliminate the requirements for KYC through various creative structures, which I don't think ended well. So I guess, who wants to take a stab at, and I'm just conscious of time, but who'd be interested in taking a stab at kind of nominating themselves or maybe a fintech for something that's been done to close that gap?
Well, look, can I specifically say in relation, it's just full disclosure, but SMBC does have an investment in it. But Marco Polo, as I'm sure you know, Morris, has got a module coming up called Supplier Pay, and that is trying to deal with this long tail, how you bring in these suppliers. It hasn't been launched yet; it's imminent. That's the promise, but like you, I've seen a lot of people promise this, and it hasn't worked yet. I think the most misused phrase in the whole of sort of KYC AML regulation is risk-based approach. We're actually not really allowed to do that. I can see Michael nodding. A small supplier, a big supplier, you have to approach them exactly the same way. I would hope the regulators would see that. Recent experience, at least in the UK, has not really shown that. but maybe things will change, and obviously we're heading into a very difficult economy where we do need to encourage that.
So we've got a good plug there for Marco Polo, which is good. We'll keep an eye on that imminent launch. As I say, I'm going to refrain from the Demica solution. Michael, what would maybe if you could add? The one that I saw that I thought was pretty cool was LinkLogis in terms of what they're able to achieve in that jurisdiction. But anything you'd add in terms of sort of exciting? Of course, nothing less exciting than Demica, but other exciting fintechs or banks that have solved the problems.
Well, of course, not more exciting than Demica, but other options. For me, deep tier financing. So this is ultimately passing on the token of say supply chain finance. You're just paying the supplier. That for me is one of the innovations that will help plug the trade finance gap that we've mentioned. I mentioned earlier on, in some of our markets in Africa, where we obviously have a big presence around the identification and due diligence, where things like passports and birth certificates aren't always as available in some of the emerging markets. We've developed solutions and apps that will be able to sort of capture information to enable people to be identified, and then that will then stay with them. Not our organization, but you see the mobile phone playing a really important part in identification in countries like India, for example. And again, that stays with
innovation in those markets, Michael. Are you seeing more innovation in less developed markets than potentially in more developed markets? Because that's always an interesting. There's always a sense that they're skipping a technology a generation in terms of technology.
I would say yes, actually. Again, we look at sort of many of the countries in Africa, again, India as well. I would say that there's been a significant jump to fulfill obviously this big problem around identification, because it's something that many of us in the West, we do take for granted, because we do have a passport, or well, we have a birth certificate, which then triggers that identification trail throughout the rest of your life, whether it be passports, driver's licenses, all these bits of information from typically trusted sources and government bodies that you can then use and in many cases use internationally to identify Michael Hart is Michael Hart.
Okay, well, there's only one Michael Hart, we know that. Next, let's move on. I think we've covered a lot of what's here in terms of some of the technology discussions. So again, I don't want to kind of repeat. We talked about sort of risk distribution, new features, and the balance between kind of what makes the difference when we looked at some of the challenges. I guess I'd be interested in, particularly, kind of Jeff and Michael, when you're going through, when you go through budgeting processes and you're getting the feedback as to what what drives the decision to say yes, increase investment. I'm interested in how that works inside the organization, and when you're talking to peers, is it uniform, or do you think? I mean, we have our perspectives, but do you think what will drive that intent into actual spend is consistent, or it's really kind of specific to the institution? Maybe Jeff, start with you.
So I think Maurice said, there's a balance that I think becomes front and center when we think about trade finance, when we think about technology and how we want to invest. And I think there are, I was sort of separated the two things, and it's sort of rather obvious, so I'm not saying anything, super consequential here, but I think when we think about traditional trade and we think about some of the ancient trade products that have been out there for however 100 years, they're all relatively paper intensive, right? So I think, and you show me a bank that does trade finance, and I will show you a bank that wishes it passed less paper through its trade finance rails, whatever they may be. So I think inevitably you've got a portion of our technology that should and is focused on OpEx, pulling expense out of our paper-based business. And I think, that will, and I think even more so of late, that gets people's attention. And I think when they sort of look at me and say, explain to me what your technology budget is aligning to, they're expecting me to say that a lot of it is going to be OpEx. And that's because A, it's the right thing to do. It's because B, we've got global initiatives to take paper out of our system from a practical perspective. I think COVID showed us that we need to be less paper focused and more digital. But then also lastly, it's more sustainable, right? So if we are now sort of thinking about it in the context of an ESG conversation, we need to be more digital and less paper based. So I think there's a good chunk of our business that has to be that. But then I think the second part of it naturally is, where then are we going to apply our investment budget towards innovation to be able to do those things in a more digital, sustainable way, which is sort of bank friendly, client friendly. We're trying to keep the pain to a minimum, and we need to sort of balance that. Here's the budget that's going to go to OpEx, and sort of us being able to create a more efficient model, less paper based. And then the other part of it is investing in the things like Marco Polo, as Sean noted, or the technologies that are out there that we want to align to and be a part of an ecosystem, right? So I think if we think about the big picture goals, I think most of us would probably agree that the future is more of an ecosystem than it is a platform. And I think if that's what we all agree, then we all have to sort of understand that part of our budget is going to be around the ability to plug into that ecosystem, right? It's not just about us developing something on a technology platform, because I think, if we were to probably be honest, this is my own personal view, the technology today is further along than our ability to use it. If you think about blockchain DLT, I've always said trade finance is a brilliant use case for blockchain. It's perfect. You've got multiple parties who all need to be sort of on a secured link with the ability to transfer both data and payments. It's exactly what we do. It's the most brilliant use case, right? And I think for all the reasons that we've been talking about for the bulk of this session, that technology works. You can go see a demo of it 1,000 times and it's out there. It's just our ability to use it. And that, I think, is where we have to apply the right intelligence to our technology budgets, both the OpEx piece of it and then the ability to plug into an ecosystem.
Yeah, no, I think that's right. I think we'll move to the next slide, the last one, because we're running out of time, and start maybe Michael with you. Your ESG. I guess my main question here is, are we going to move from intent, which is clear, right? And you don't need a survey to tell you that ESG is important to people, right? It's top of mind. It's on every conference. Are we going to move from intent to action? And how can banks really drive that and make it happen, right? Are they going to be driving it, or are they going to be following? And my supposition, kind of my assumption is they'll follow rather than lead, but I hope I'm wrong. So I'd be interested in yours.
Yeah, I mean, the ESG sustainable finance piece, I do see banks playing a very important part. I would certainly expect them and hope to see them leading rather than just following. We've seen a number of, again, without promoting my own organization too much, I mean, I've seen our organization already complete a number of sustainable finance ESG type projects, infrastructure projects, projects with corporates, with a sustainable finance very much at their heart. Where I would say perhaps if anything, with the follow comes, is it's being driven by the corporates first. So sustainable finance ESG goals are very much increasingly, and for the good, at the forefront of corporate financial statements. It's part of their ethos, it's part of their mission statement. We're seeing that. So the follow part is because they're now coming to us and saying, well, what can you do to help me achieve this goal, whether it be through carbon footprint. Some of it's being led by the consumer. You think of electric vehicles. For many of us, for a long period of time, the only electric vehicle they really knew was the Prius, and now there's obviously Tesla and there's Polestar, because that demand's there. So you're seeing banks, yes, servicing a need, but you're also seeing banks use innovative products and different ways of providing trade finance to facilitate that as well. And we've seen examples of funding being applied to industries like shipbreaking, for example, very dangerous, very potentially very toxic industry. Finance has been used as a condition of improved working conditions for people that do that in very hazardous, very difficult markets. And if you improve your working conditions, then the advantage or the incentive is A, access to funding, and B, better pricing for funding. So I think I think the banks definitely are playing a role in terms of leading it. I think equally I see banks coming up to that plate and working with corporates, which is being driven by consumers, to make sure that those products and that innovation is coming through so that it actually works.
And are you seeing risk? Are you seeing pricing differentiated against whether a project is ESG rated or not from a bank perspective?
Yeah, we are. So again, supply chain finance, particularly where there is a ESG goal, or it's evident that there are good practices being followed, you're seeing preferential pricing come in, sometimes driven by the client themselves, that certain suppliers, if they are meeting certain goals and objectives, KPIs, preferential pricing is being applied.
Okay. Sean, I know you've got some views on the subject.
Yeah, so I mean, look, I think when we look back in sort of 5, 10, 15 years of the history of how this has all happened, because I'm sure we will end up actually in a place where ESG is being promoted very heavily by banks and is central to corporate activity. But I think what you'll see is that there's been quite a lot of will have been quite a lot of compulsion here. I mean, you can't. We wouldn't have got even to the point we've got to now if it was all left down to voluntary code. And if you believe that this is a good thing, and I do believe that, then you do need to force everybody a little bit. You're seeing that in Europe and elsewhere. The SEC coming out with standards. I know they're not exactly clear yet, but they've started down that road. The EU, UK now with its own taxonomies, reporting obligations. In relation to banks themselves, there is a price difference, but I have to say, so far what I've seen is pretty marginal. Part of the reason for that is a lot of this is quite hard to measure. I think that's the big issue that I see, and something actually we're working quite hard on it for, is to say, well, look, there are all these people who are coming out with the laws, but actually, how do you measure performance against that? And actually working with some really interesting tech providers to see what we could bring to that. In supply chains, it's a bit more difficult, especially when you're going into the second and third tier suppliers and really trying to track the product right back to its sort of raw materials. But that has been done. There have been some use cases where it's been done. It hasn't, I think, been widely rolled out, but consumer demand is part of it, but I do think there's a lot of sort of legal compulsion here. That after COP26, pretty clear how the wind was blowing. I think one of the interesting things for banks will be, will they not only have to do it, but will they be rewarded for doing it in the form of lower capital costs? And that, I'm sure Michael nodding very vigorously.
Is the incentive?
Well, so those incentives at the moment, it's more stick than carrot, I have to say, but that is, that's a debate that started, and we will get to something on that. I'm quite sure of it.
So we've got one question I think we'll close on, and that is, how do you see accounting treatment or rating agency treatment of trade receivables products shift market demand? So I guess I'll put that to Jeff for his view.
Look, I'll be optimistic. And, I've spent a lot of time with FASB in the US and IASB. And, I think what they always open with, and I don't want to put words in their mouth, but I think it's, a recognition that there is a lot of very important financing that happens through the banks through some of these techniques. And they don't want to impact demand for those things where it's needed and where there is really no concerns that there is anything untoward going on. I think that's sort of their opening, jag when we talk through some of the projects that are underway. So I think at the end of the day, you know, what wins is the fact that this financing is valuable and necessary. It's proved itself through a couple of financial crises. So I think there's enough incentive for everyone to figure out, how do we do this in such a way where it can be a little bit more perhaps open, or it can be a little bit more disclosed, or whatever that might seem to be, without impacting demand, i.e. make it so restrictive that corporates are saying, you know, it's not worth it. You know, I'll be optimistic and say I think that we will find a path where there's an element to it that, you know, everyone can get comfortable with the methodology, with the model, and that demand stays where I think the demand is, because I think for a lot of companies it would really, and the way I always sort of portray this is, it would impact the largest of the buyers, sure, but really it would impact the smaller suppliers. And the trade finance gap only grows if you make it difficult for us to provide the financing. So I'm optimistic, I suppose. Well, I will be optimistic.
Well, it is good to end on an optimistic note, and this has been an optimistic discussion, which has been great. So I'd like to, we're coming up to the hour. I'd like to thank everybody who joined us and our panelists. So Sean, Jeff, and Michael. It's been a really good discussion. I hope any of you have questions on the survey or want to reach out to us, please do. And thanks to Dan and Catherine for pulling it together and for your hard work. So I think, Dan, that probably brings us to the time where we close the discussion. So thank you very much.